Okay, so let's talk about a huge business myth. You know how we're always taught that profit is everything, that it's the number one goal? Well, what if I told you that focusing only on profit could actually kill your company? Seriously, today we're going to unpack this wild paradox of why a totally profitable business can still run out of cash and just go bankrupt. I know. It sounds like some kind of brain teaser, doesn't it? I mean, a company is killing it on paper. Profits are climbing, everything looks amazing. And then suddenly, bam, the lights go out. And look, this isn't some rare one in a million thing. It's an incredibly common trap, and we're going to figure out exactly how it gets sprung. This right here, this is what we call the profit paradox. It's that terrifying gap between the happy story your profit and loss statement is telling you and the cold, hard reality of what's actually in your bank account. So, to really get our heads around this paradox, we've got to start with the basics. We need to understand the huge difference between two words we throw around all the time, almost like they're the same thing: profit and cash. Spoiler alert, they are not the same thing, not even close. And knowing why is absolutely crucial. I love this analogy because it makes it so clear. Think of profit as your company's scorecard, right? It's your revenue minus your expenses. It tells you how well you played the game last quarter. It's a report card on past performance. But cash flow, oh, that's completely different. That's the fuel in your tank. It's the actual real money sloshing in and out of your business. And that fuel, that's what determines if you can even start the engine tomorrow and survive to play another day. Okay, enough with the theory. Let's make this super real with a story. Our first case study is a classic scenario. I like to call it the receivables trap. This is where a company looks like it's absolutely crushing it on paper, but in reality, it's just teetering on the edge of a cliff. All right, so picture this. You've got this growing company, and they just closed out a killer quarter. They've booked a whopping 50 lakh rupees in revenue. I mean, the sales team is popping champagne, the investors are ecstatic. On the surface, it looks like a massive win, right? And it gets even better. You look at their P&L, and after all the expenses are paid, they're left with a super healthy 10 lakh rupees in profit. I mean, by any textbook definition, by any traditional measure, this company is absolutely winning. So, you're looking at these numbers, right? The revenue is huge, the profit is strong. So what's the problem? What could possibly be wrong here? And boom, here's the twist. The reality? Their bank account has just 2 lakh rupees in it. How is that even possible? Well, it turns out a staggering 35 lakh of that so-called revenue isn't actually in their bank account. It's still sitting in their clients' bank accounts as unpaid invoices. But here's the thing, their own bills, for salaries, for rent, those have to be paid with real actual cash. And that's the heart of the problem. They are paper rich but cash poor. This breaks it down perfectly. So look, step 1, a sale is made. Awesome. The revenue gets booked on the scorecard. Step 2, the cash doesn't show up right away. The client has 30, 60, maybe 90 days to pay. But then comes step 3, the company's own bills are due now. And suddenly, there's no actual cash to pay them. That's a classic liquidity crisis, and it all comes from that simple but deadly timing gap between earning the money and actually having the money. Okay, so that was one side of the coin. Now let's flip this whole thing completely on its head. In our next story, we're going to look at a company that is absolutely swimming in cash. But if you ask their accountant, they're actually losing money. How weird is that? So let's imagine a software as a service company, a SaaS business. They just landed a huge deal. They sold an annual subscription and got a massive payment of 1 crore rupees all up front. Their bank account looks incredible. They're absolutely flush with cash. But then their accountant runs the numbers for that first month, and the profit and loss statement shows a loss of 6.7 lakh rupees. And you're just like, wait, what? They have almost a crore sitting in the bank, but on paper, they're unprofitable. How does that even work? Okay, so the secret here is a little accounting rule called deferred revenue. See, because the company got paid for a full year of service, they can't claim all that money as revenue in month 1. They have to earn it over the 12 months. So in the first month, they can only recognize 1/12 of that 1 crore, which is about 8.3 lakh. But let's say their actual expenses for that month, salaries, rent, marketing, were 15 lakh. Well, you do the math, revenue of 8.3 lakh minus expenses of 15 lakh, and you get a loss on paper, all while their cash position is stronger than ever. So these two stories really highlight the core problem from both sides, right? But believe me, they are not the only ways cash can just vanish. let's run through some other super common traps that can catch even the sharpest entrepreneurs completely off guard. Okay, here we go. Think about buying inventory. What is that? It's just cash sitting on a shelf, waiting to be sold. It's not in your bank. Or what about hiring too fast? That's a guaranteed way to crank up your monthly payroll bill before you've started collecting the cash from all the new business. Then you've got big equipment purchases, loan payments, paying your suppliers before your customers pay you. All of these are like tiny leaks in your fuel tank, draining your cash often without you even noticing. And here's a big one. Taxes. You have to pay tax on the profit you booked on your scorecard, not just the cash you actually have in hand. Ouch. So, okay, we've seen all these traps, all these potential disasters. What's the big takeaway here? What do we do about it? Well, it really all boils down to one golden rule for growing a business the smart way. I really want this next part to stick with you, okay? If you remember one thing, make it this. Profit ignores timing. Cash flow punishes timing mistakes. Let me say that again. Profit is just a historical record. It doesn't care about timing. But cash flow is the real-time, minute-by-minute truth of your business, and it is absolutely ruthless when you get your timing wrong. This leads us to the million-dollar question, doesn't it? The question every single founder has to face. When should you scale? Because look, knowing the difference between profit and cash is one thing, but knowing when it's actually safe to put your foot on the gas and accelerate your growth, that is everything. And here's the answer. You only hit that accelerator when 3 specific things are true. First, your unit economics are healthy. That means you're making a real, sustainable profit on every single thing you sell. Second, your collections are disciplined. You're turning those invoices into actual cash in the bank fast. And third, your working capital is under control. The money you need for your day-to-day isn't getting stuck somewhere. At the end of the day, it's this kind of discipline that builds companies that last. So I'll leave you with this question to think about. Are you just watching your scorecard, or are you obsessed with how much fuel is in your tank?